10-year Treasury yield hitting nearly one-month highs earlier today, having gained about 20 basis points this week. Wells Fargo says surging oil prices are the #1 reason for the move and warns inflation is a clear and present danger. Michael Schumacher is behind the call. He's the firm's head of macro strategy. Michael, it's always great to have you here and get your take on things. So the markets don't seem to think that oil, like the shock, is going to be anything lasting.
I'm not so sure about that. I think people are struggling because none of us really in fixed income, most of us anyway, are not really great at analyzing geopolitics and probably not oil in particular. It's tough to really think about how long it goes. I will say if you look at the prediction markets, poly markets got about a 50% chance it's going to April 30th. That's a long time. Tough deal for bonds to digest. It's probably pretty negative, actually, if that happens.
Do you actually look at Polymarket on a regular basis to inform you about what is going on?
I look at all useful information. I'll take granules from wherever I can get them. So that's one.
I was just curious. So it seems like then the fixed income market is sort of lined up with that thesis, but the equity markets may not necessarily be lined up.
Great point. Yeah, big disconnect there, right? S&P's down, what, a couple percent this week? Yeah. Not much, really. European markets a bit worse. Bonds taking it on the chin. It's that inflation fear. It's that concern about oil. People say, well, oil was sub 60 really probably a week and a half, 2 weeks ago. Now it's 90 plus. What's the next stop? Is it done here? Does it go to 120? It's pretty difficult to call. And if you think about the move in the bond market, it's really very evident because in bonds you can price that inflation component, that break-even component. It's gone way up. And that very, very evidently is driving rates, especially shorter maturities. So people are having a tough time.
Michael, let's take you to the other part of it is the dollar. And you know, today was the day when equities, bonds, and the dollar sold off. And you had a dynamic at least where, where do we start worrying that the flight to quality wears off and this becomes a little more concern about growth dynamics? You get more of a Fed involvement. And if we say that the Fed is more concerned about the job market than they are about inflation risks, you're going to see people start to look at the central bank differentials again. So.
It's a great point. And I think, Tim, you've got to say, well, exactly how comfortable the central bank officials have to get with the idea that oil has peaked, or just how high does it have to go to really break that thesis? And I think it's quite a ways up. So we've looked at lots of previous episodes with oil surging 15, 20, 50, 75%. It's difficult to find that tipping point. In listening to the policymakers over the last couple of days, there have been at least a few, I get the sense they're quite a ways from making that determination. So we think that's a ways off still.
So, hardball for you. If you're the Fed, what do?
You watch and wait. No reason to go in March. No reason to go in April. You've got the new chair coming in who people aren't really paying attention to right now, but still it's an issue. I think you hang out for a while and say, let's just watch this unfold for a few months. We're just not really sure why make a big splash right now. No reason to do it.
So, Michael, I look back on the jobs numbers, and I was surprised to know that in the last 5 years, healthcare was responsible for 40 to 50% of job creation. When you see the hangover from COVID, is this a pullback, getting back to an average, or is this a COVID overhire in both healthcare and the rest of the economy that we're sort of finding the right level?
Really tough call. Probably need confirmation from a couple more reports, I would say, but it did strike people. This is the time that healthcare didn't really step up. So it's got people a bit more nervous. I will say that the bond market concern about the jobs report probably lasted 5 minutes, maybe 10. So today, too much is going on. But if this happens again next month and 2 months out, then I think you've got a really great story there.